I've been investing in emerging markets for around 18 years now, and over that time there's been a massive change in corporate governance standards. I think that the best evidence of that improvement in corporate governance is the fact that the percentage of emerging market companies that pay a dividend today is higher than it is in developed markets. And I think that's a stat that would be quite surprising to many investors. There has been a big change in that willingness to return cash to shareholders. So there's still very much this perception that commodity prices matter a lot for emerging markets, but the significance of commodities has declined massively over the years. If you look at the emerging market universe today, around 70% of that investment universe is now made up of IT, financials, consumer and healthcare companies, and those companies clearly aren't commodity dependent. So I think we should recognise that it's not a commodity play anymore. In our view, all of the value that we believe we can add in emerging markets is from the bottom up. So we believe that stock selection is where it's possible to have a real edge, to find something different in a company that other people haven't fully recognised. We don't take macro views, we simply look to diversify the macro risks that the portfolio is exposed to. While many investors have been buying ETFs to access emerging markets, in fact, the majority of fund flows into emerging markets this year have been through ETFs. We believe that there is a much more compelling exposure that an active manager can build. That's because some of the very best stock ideas that we find in emerging markets are in the mid and small cap space and aren't represented in ETF or index exposures.